All right, guys, thanks for tuning in. Just going to show you a few charts here, kind of outlining the current situation in Canada with our pretty crazy house prices and the economy in general. This first chart is showing you average home prices. So as you can see, back in 1980 it was around 50,000, and now we're up right around 500,000. This chart's only going to 2011, so we've climbed another 100,000, 150,000 since then. So yeah, pretty out of control, just constant rising. A lot of people are afraid that if you don't get in now, you're never going to get in. So people are just doing whatever they can to get a mortgage and get into the market. Probably not the best idea. Most likely we'll be seeing a sharp correction here, because that's usually what happens after a big bull run like this. So here you can see this chart is outlining household debt to income ratio. The bottom line is the US. So they kind of hit this critical point back in 2008 where they were forced to cover a lot of the debt, and they had to liquidate a lot of their homes and their assets and sell it off and pay off their debt. So now they've done that. They've come way down. But in Canada, quite a different story. We continued to borrow, and we just brought it up near these just insane levels. Very, very dangerous. Everything is on borrowed money here in Canada. So we're very at the mercy of interest rates, etc. So here you can see house prices. This is what happened in the US when they kind of hit that threshold. They were forced to start selling their homes, and when everyone's selling their homes at once, what happens to home values? They come way down. So as you can see, they peaked just below 300,000 here, and then they dropped all the way down to 200,000, for your average home. So most likely Canada's going to be seeing the same in the next year or two, or probably 2 to 5 years to be more realistic. Yeah, we've just continued to climb. So, an average home being $500,000 is just you're not able to support that. If you go back to, the average house prices here, we've gone from 50,000 to 500,000. That's an increase of tenfold for your average house. Wages are quite the opposite. The average tradesman back in 1980s made about 25 bucks an hour. Now he's making 30, 35 bucks an hour. So really it's like a 15 to 30% increase in wages, if that, and we've had a tenfold increase in house prices. So totally unsustainable prices. The only way Canadians have been able to sustain these prices is through very loose lending practices by the Canadian banks and record low interest rates. So here's our interest rates since 1960. They went as high as 22%, almost 23% in 1980, and we've bounced around. Most of the time we're bouncing between 5 and 10%. For the majority. The average rate since 1960, 7.35%, and we're currently sitting down at about 3.5%. So never in Canadian history have we had this cheap of money. So what's happened is a lot of people were paying high rent and started doing the math, a mortgage compared to renting, and it appeared on the surface that, getting into a house, buying with such low borrowing cost, it just made more sense to buy. So a lot of people jumped in to the real estate market in the last bit here. A lot of the younger generation, first-time home buyers, stuff like that. But, we haven't experienced, look at this, it's just like we've never been this low, and if we start bouncing between 5 and 10%, like we usually do, there is going to be a massive increase in the cost of holding these massive mortgages. You can just imagine the interest payments doubling on a $500,000 mortgage, and that's only going from 3.5% to 7.5%. Imagine being in some of these points where we hit 15%, 20%. It would just totally wreak havoc on the Canadian real estate market. So a lot of people think interest rates will never go up. That's actually a bad thing, in my opinion. Having interest rates this low is actually just devaluing and destroying the Canadian dollar, and you just lose all buying power on the world market. A good example of that is here in gold. If you look at the price, this is US price of gold. So back in 2011, early 2012, we hit the peak, and since then it's come down. We're sitting 40% below the peak price of gold in American dollars. But if we look at Canadian price here, here was the peak back in 2011. We're almost right up to that peak level again. So the Americans are 40% below, but we're only 9-10% below the peak. So what that's showing is that the Canadian dollar is really losing its buying power. And you probably have been noticing that when you've been doing your shopping, you know, paying $5 for a cucumber and, you know, $7 for a head of cauliflower. Stuff like that. You know, I went to the store the other day, it's $5 for a donut. What is going on with prices? Prices of oil. It's, you know, prices of, that's also what's driven up the house prices, is just the devaluation of the Canadian dollar. So it's not good having your interest rates at this low. The other thing it does is it punishes savers. Why would you bother saving if you can't even make a percent on your savings, you know, and at the meantime you can pretty much borrow money for free. So it's not a good thing. Hopefully they do start to raise rates, and hopefully you all aren't too overextended. If you are, now is a good time to start paying down your debt, getting those debt levels down. Canada at the moment has the highest debt levels per capita in all of the world, so that is not a good thing. Here's a lot of the bigger countries in the world, the blue representing the advanced economies, and Canada ranking #1 in household debt. So as you can see, they're 100%, over 100% of GDP. Not a good thing. Totally overextended in the Canadian markets. For some reason, everyone has it in their mind that prices are going to continue to go higher, and we just can't support it, especially once interest rates start creeping up here. So, you know, if you bought in the last 5-10 years and you have a good stable job and whatever, good on you. You know, you probably got in at a good time. But on the other hand, if you just bought in the last 5 years, you know, and you're just kind of struggling to make your current payments, probably a good idea to get out of the market. You probably can't afford the house. You got to be realistic. So, yeah, you really got to look at what's going to happen when interest rates double here pretty quick. So, thanks for tuning in. That's just kind of an overview of the Canadian housing market and what's going on in our economy in general. Just kind of outlining the massive debt that we've taken on, and that's really helped push these prices up to just unbearable levels. So odds are that we're going to be seeing a very sharp correction in the next few years here. So just wanted to help inform you guys so you can make good decisions. Keep your eye on some of these charts, specifically this household to debt income, critical chart to pay attention to, and we're at unsustainable levels. So that's going to be having a sharp turnaround pretty quick here as the bankers ask for their money back. So yeah, hopefully you're not too overextended, and thanks for tuning in and listening. I hope you enjoyed it, and I look forward to bringing you guys some more videos in the future. Have a great day.